Hello everybody, I'm Cantonese Cat. Hey everybody, Cantonese Cat here. I'm going to show a video on CNBC of another interview with Tom Lee. There are a lot of contributors to CNBC that I cannot stand. Tom Lee's one of those that I love. Let's hear what he has to say about the broader market, about macro, about all that.
When it comes to finding overall value right now, our next guest points to October as a seasonally iffy part of the year, expecting investors to buy whatever dip emerges this month because the positive tailwinds into year-end, he says, are stronger than the headwinds. Joining us today is Tom Lee, Fundstrat Global Advisors Managing Partner, a CNBC contributor. Hey, Tom, good to see you.
Hey, Carl, how are you?
I'm good. What do we make of the market in light of the jobs number and a VIX, which I know you're watching, but is still close to 20 today?
Yes, I mean, I think we're in a tricky period because there are these sort of complications, which is geopolitical risk. We've got the port strike out of the way, and I know October has these seasonals. I think it's very good news to see the stock market react positively to a jobs report because it is.
Sorry, I'm going to cut him off here a little bit. He was talking about the seasonal. Let's see whether or not that's true. I'm going to go ahead and pull up the let's see, let me pull up the VIX here and kind of give you an idea of what he might be a little bit worried about, or I'll even actually just go for S&P 500. Kind of give you a little idea in terms of what he's worried about. He's worried about the seasonality of October. What happened after last October? Well, you had a big giant run up, but October was a pretty terrible month. The October before that, we really had a pretty bad wick down to here. This is like the 2022 low right down here, but since then it's just been kind of going up after that, right? What about the October before that? Well, we were on a bull market. October actually didn't do too badly over here, and the October before that was actually pretty bad, and there's a pretty bad seasonality there. So I can totally see what he means by that. If you just all look, October, there's usually a lot more volatility. There's usually a lot more of these kind of wick that goes into it. The previous October here also didn't do too well, right? So I can see totally what he means by that. Does it guarantee that you're going to have an end of the year season rally? Potentially it could happen, but it doesn't always happen, right? There is a concern in terms of October seasonality, in terms of geopolitical risk. There's always concern with geopolitical risk. I'm not really that concerned about it. Let me just kind of put it this way. Like, the Middle East have had conflicts for really about like 50, 60 years, if not longer. And there's always going to be some push and pull. There's always going to be some unfortunates where there will be things that are bad that are happening in that part of the world, but it doesn't necessarily mean it's going to be bad for the U.S. economy. That's just the reality of it. The other thing too is we've really gone through a lot over the last few years, including an ongoing conflict right now that nobody's really talking about. The Russian and Ukraine conflict that is still ongoing right now. So, I don't know what exactly to kind of make of it. We'll see how it kind of unfolds over time. There's even a lot of geopolitical risk and concerns when it comes to the the China and Taiwan situation, where Nancy Pelosi was visiting, and there's a lot of people just kind of freaking out. I think markets just want to freak out because they needed to correct, not necessarily because there's any worries about geopolitical risks. Although all these things are going to always lurk in the background. Now, does it mean that you should invest based on what you worry about geopolitical risk-wise? Well, it depends. Like, if you're investing in the U.S. market, then maybe it's probably not that big of a deal. But maybe if you want to invest elsewhere in the world, for example, if you worry about the geopolitical risks in like China, then hey, maybe that just maybe take that into risk consideration here. Now, is October always bad for all assets? The answer is no. Right. October actually traditionally has been doing pretty well for Bitcoin. And you can see October over here, a big giant green candle last year. October last year was green. The year before that was green too, in October 2022. And this is during this big giant vicious drop, right? October before that, it was a green candle. October before that, it was a green candle. So Bitcoin actually does really well for October. October before that, green candle, right? October before that, a little bit of a muted response here before a big giant plummet in November. But in general, October is a very good month for Bitcoin. So I actually think that maybe if you really believe in the whole seasonality thing, which I do a little bit, but I don't really care because I play more cycles. October is just 1 month out of the whole cycle, but yeah, it generally does pretty well for Bitcoin, which is interesting, right? Something to think about. And if Bitcoin does well, it probably means that maybe a higher beta thing like IWM might also potentially do pretty well for the month of October. Now, October was pretty bad last year for the IWM, but October was pretty good in 2022. October was pretty good in 2021. October was pretty decent for 2020. You know, October is not really that bad for the higher beta stuff, right? Except that for 2018 was pretty bad. So I don't know whether or not the whole like October seasonality would necessarily apply to every single thing. Maybe S&P 500 will have a little bit of a muted response, maybe even have a little bit of red month, and that would be fine because it's just one of those things that after you have a big time run up like this, would it be a problem in October and ends up being like a red month? No, it would not be a problem. Actually, it'd be a pretty healthy thing. So let's keep hearing what Tom Lee has to say.
Is, in fact, a good report showing the economy is actually not only holding up, but the unemployment rate's down. But I agree with you. The VIX is important to tell us how much we could rally. I know our head of technical strategy, Mark Newton, thinks that we're making intraday lows today, and it's setting up for us to make new highs next week. I mean, to me, that makes sense just because it has been a resilient economy, and then next week we get CPI. But I do think it's hard to say this is a green light into year end because, as you're pointing out, the VIX is just staying stubbornly high.
It is important to take into the context that this very, very nice and smart gentleman is a fund manager. So he's going to take into a lot of these short-term moves into consideration. Now, if you ask me, some people say like, hey, you can't really chart the VIX. I disagree. I think you can chart the VIX. I think the VIX is perfectly chartable. And if you're charting the VIX, it does make you think about the consideration of like, hey, where we are right now. Are we in a period where there's going to be a VIX going up, you know, potentially for the next 2 or 3 years? And if that's the case, then you're going to have a lot of sideways action over here. Like 2018, 2020, the S&P 500 did nothing. And if you have a potential rise over here, like from around 2015, 2016, the stock market did nothing, right? And the issue is like, where exactly are we? And you have a rising VIX like we did in like the Great Financial Crisis, then you can have a big giant drop in the S&P 500, right? So where are we at right now? Are we at a location where it could potentially be a lot more volatility going on for longer? Let's kind of take a step back and take into consideration of that. Now, the way I see it is this. You do have a 20-month moving average just crawling up. You do have the VIX currently above the 20-month moving average. And it does look like it might be developing a shorter-term bull trend here after having a bear trend on the VIX for about 2 years now. Right? So anybody who really was like that bearish around, let's say, like November 2022 to like December 2022, and the VIX actually broke down underneath and back tested and failed, and it just kept going lower. Anybody who's really like that bearish for the market is wrong, right? That's just the way that it is. Now, does it mean that we reclaim the 20, we hit the upper Bollinger Band? Does it mean that the trend is reversing? We're going to go a lot higher from here? Not necessarily. Throughout the times, you're going to have some period where you're going to have a slight rising 20-month moving average. You're going to have the VIX going above that. But it doesn't necessarily mean that the trend has changed. It could still plummet down. It can still potentially ride the 20-month moving average, keep riding it down for a very, very big rally, right? Just because you have this over here doesn't necessarily mean that it's going to be lasting for that long. You could potentially have just lasting for a little bit, and then that's it, right? So I don't really want to like fear monger. I don't think that the VIX has to necessarily just keep pushing up. Matter of fact, I think that is important to take into consideration too when you're talking about the VIX, whether or not it's going to keep going up or is it going to keep going down. You basically just look at history in terms of what the VIX does with the global liquidity index here. The way to look at this is that you basically almost always have a big spike of the VIX whenever, and this is very, very interesting. You almost always have a big spike of the VIX whenever you have a big spike in global liquidity, which basically means that I think the market might have bottomed whenever you have a big spike of volatility, right? We have a big giant fear in August 5th. Everybody woke up on Monday morning, everybody was freaking out. And that's in the context of having great increase in global liquidity, right? Same thing over here during the COVID lows, that was precipitating a big giant increase in global liquidity. And that's exactly what happened, right? Because the economy was shut down, they just started printing money like crazy. So the VIX went all the way up, coinciding with, almost like a spike in the global liquidity, right? Now, here with this spike here is a little bit different because we did have a spike up here, but things were kind of going sideways here for a little while. So this might be anticipating that maybe the market participants are trying to exit the market because they think that the global liquidity is going to be stagnant, right? But in this particular case, it does look like it was precipitating the breakout of this global liquidity here. So there are really two scenarios here. One scenario is the big spike is happening because they're trying to shake you up because the market makers know that the market is probably going to go up and they're trying to do a little bit of like a shakeout using some kind of macro event, yen carry trade or whatever, and they're trying to shake you out. Market participant there might be some real fears here, but they are anticipating that the Fed's going to end up, bringing a huge amount of liquidity going in, and they end up bringing a bunch of fear and trying to shake you out, right? And then over here in around 2015, that was also on the back of having like a big giant rally that had happened all the way from 2011, 2015. The stock market just needed to cool down. Global liquidity just simply needed to cool down. And whenever that cooled down, you do have a little bit of a, sideways price action here. Actually, 2014 was a pretty decent part for the stock market. But when you have this spike right here, I think they're anticipating for an increase in global liquidity to come in, and they're just trying to shake you out, get your shares. That's exactly what happened, right? Same thing in 2021, So I actually don't think the VIX going up necessarily means that it's going to just continue going up. Matter of fact, I think that whenever there's a big spike like this, generally VIX tend to kind of go down over time. Whenever a big spike like this, generally VIX tends to go down over time. Whenever you have a big spike like this, generally VIX tends to go down over time. And especially in the context of rising global liquidity, that usually is more of a potential sign for a shakeout rather than anything bad. So anyway, let's get back to my friend Tom here and see what he has to say.
Tom, we've seen some changes in the swaps market with regard to expectations for future rate cuts, at least in terms of magnitude. How does that alter the calculus, if at all, for the equity markets? If it is now looking more like a 25 basis point cut in November instead of 50 basis points in those weightings changing, does that impact expectations in the equity market, or that's not really priced in at this point in time?
Well, we know that Fed fund futures and expectations about the magnitude of cuts over the next couple of meetings does affect the bond market. And we're seeing that reaction today. And, of course, I'm even seeing some folks think the Fed made a mistake with 50. But for the stock market, I think what matters more is really the Fed. The Fed is actually in an easing cycle, and we're making our way towards neutral. And so
it's important to know that the Fed is in an easing cycle because this is the U.S. 2-year, not 2-year, this is the M2 money supply, and this is a monthly chart. It's important to know that the Fed has really started quantitative easing from October 2023. So if you listen to what the Fed is saying, you're lagging behind by about a whole year. If you listen to what the Fed is saying, you're lagging by about a whole year. Don't listen to what they say, see what they're doing. And what they're doing is they really have stopped quantitative tightening that started around March 2022 or April 2022. That has stopped in October 2023. Since then, we've had an easing cycle, and currently from July to August, and this data is lagging a little bit, but from July to August, there's a huge jump in U.S. liquidity being in the system, right? Like this is quantitative easing. There's no doubt about that. And the other thing too is whether or not there is any impact on the Fed's funds rate on the market. Now, the answer to that would be, again, it's a very, very similar answer here that I'm going to have. I'm going to do this on a regular instead of a log here. It's a very simple answer that I have is this. if you're listening to what the Fed is doing, because the Fed effective funds rate has not changed until just recently, right? Like they have not changed this until just recently. It stayed like this. It did stay higher for longer, for a whole year, around 5.3%, right? But if you're looking at what the market is doing and what the market expectation is doing, is that since October 2023, the rate has dropped by more than 1%, right? Like the market has already anticipated, and this has already have caused a lot of quantitative easing to happen, and it already had caused a lot of easier for liquidity to go around. 10-year, same thing, peaked around 2023, has dropped by about a whole percent since then, right? Even before the Fed does anything. So the Fed is already looking at the market and saying, oh, the market is already doing the cuts for us. We don't have to do anything. That's exactly what's happening. So I'm not really that worried about what the Fed is doing right now. As a matter of fact, if you look at the 2-year, why do we end up having a big bounce even after the Fed's just cut, recently, right? Why do we end up having a big bounce? Was because the Fed funds rate is lagging significantly, but the 2-year is already overextended to the downside, and it hit the lower Bollinger Band. When you hit the lower Bollinger Band, it's completely normal to have a little bit of a bounce. But make no mistake about it, lower Bollinger Band continues to go downwards, and you have a 20-month moving average continue to point down. So make no mistake about it. I think rates probably going to plummet down to like maybe 3 or even 2%, maybe around 2025, maybe around 2026. I think rates continue to go down. But you're going to have a lot of these weird narratives. And I was just sniffing, and I was like, yeah, I think rates probably overextended to the downside. A lot of people might get kind of caught off guard. They're saying, oh, rate cuts, IWM should just moon from here, right? Well, not necessarily. IWM has already moon for about like a whole year, because because the market conditions are already saying that the rates have bottomed in October 2023. So they've already mooned for like a whole year, and right now we're just having a little bit of consolidation over here for this big giant cup over here with a little bit of handle over here, and that's kind of exactly what's really happening. So, and to kind of give you an idea in terms of what I mean by like quantitative easing has already happened, just look at the mortgage rates, right? The 30-year mortgage rate is already plummeted from like 7.8% down to like 6%. And it's hitting the lower Bollinger Band, so you're having a little bit of a dead cat bounce here. But you can see that the 30-year yield has already been making lower high here and the lower low here. So it's probably going to go down a lot more, and that's probably going to be good for the economy. There's really no sign that it's crashing. I don't see any reason to worry that the banks are going to fail. So that's kind of where I'm seeing right now with that. I'm going to keep finishing up the video here. He's going to talk about China next.
I think that there is going to be times where the stock market, where the S&P is going to rise even if yields are up. I think we're in an instant there because yields can be rising because the economic data is better, and so we're kind of rising for good reasons on yields, and I think that's supportive of stock. So I'm not too bothered if the odds of a 50 have dropped today because of a good jobs report, because I don't think it means the Fed is suddenly backpedaling and back to hiking mode.
On China, Tom, is it good for global growth? But how is it offset, if at all, by any kind of drains to liquidity or just the rush of hot money to either cover shorts over there or try to play along with this?
I think on balance, it's very good news that China's PBOC and the government have launched a bazooka series of measures because it has been, on a relative basis, a drag not only on the global economy, but a huge underperformer for the past 10 years. I don't think U.S. investors are selling their U.S. equities or even small cap stocks to buy China. I think it's coming out of all this cash on the sidelines. We know margin debt hasn't moved for 4 months, and it's still way below the 2021 highs of $936 billion. And we know there's $6 trillion cash on the sidelines. So I think this is motivating money into action, but it's overall, I think, a positive.
This is Project 2025.
To kind of give you an idea, the China market cap is very small. I actually don't think that there's any reason to think that the increase in China equity prices over the last month or so is really going to reflect badly on global liquidity. If anything, global liquidity is rising, right? I just showed you global liquidity is rising, right? And we have just had a little bit of a breakout here. Now, If you are asking me whether or not I want to buy China, the answer is for trade, it's been very tempting because it does look like the Chinese stocks are at a good spot in terms of having a little bit of reversal, right? It does look like they're actually doing very, very well. And you already knew that just based on looking at the chart. You already knew that the 20-month moving average was already curling. And over the last few months, it was trying to break out. I already told you this. Like, if it breaks out, it's going to make a very powerful move, and it did, right? Where is it at right now? It's at some resistance here on the monthly Ichimoku cloud, right? So I'd be probably a little bit cautious to enter China right now because it's no joke whenever you hit the bottom of Ichimoku cloud after a big giant move like this. Usually it wants to cool down a little bit. Now, is it going to cool down by going underneath the cloud again? Is it going to go down inside the cloud and just kind of hang around the bottom here? I don't know. But I do worry about it being a little bit overextended, especially if it's been overextended on the monthly Bollinger Band. On the long run, I think the next like 12 to 18 months, I think it's going to do pretty well. Now, if you ask me whether or not it's going to be concerning for the U.S. Equity market for a long run, probably not. Just to give you an idea, like if you do the Hang Seng over SPX, what are you going to get? You get a chart like this over the last decade and a half. It just looks like China's economy is going bankrupt. Like this looks like a bankruptcy kind of stock here. I'm not to say that the country is going bankrupt or anything, but this is like the kind of feel that I'm seeing. There's a big giant falling knife, and you're having a little very much of a small deckhead bounce, but the 20-month moving average continues to go down. Like if you ask me whether or not I want to buy China versus stay in the U.S., my answer is I want to stay in the U.S. And in general, when China does well over the last 15, 16, 17 years, the U.S. economy is going to do well. Like it's just the U.S. is still the world's reserve currency, so the U.S. is still kind of going to do pretty well. Now, where are we at right now in this cycle? Are we at the cycle where China is going to actually outperform the U.S. for the foreseeable future over the next few years, 10 years? I'm not really seeing that trend change, right? Again, the 20-month average is kind of going up. We do have a period of time where it can end up closing underneath the 20, like it did over here, but it doesn't necessarily mean that the trend is changing, right? The trend is still very powerful to the upside. The U.S. economy is still, outperforming the Chinese economy. Matter of fact, if you look at the S&P 500 over the Hang Seng ratio chart, you basically see that on the month so far we're finding support here on the Kijun, and on the 3-month chart we're finding support here at the Tenkan, right? So I think that at some point we might be hitting some support of U.S. stock over Chinese stock, and also think that we might be at some resistance here for the Chinese stocks here too. So I probably won't, enter this China trade just based on what I'm looking. But anyway, just wanted to share my thoughts here with you. Have a good one. Take care.